All right, today's video, I want to talk about the wheel strategy a little bit, but mostly this has to do with a lot of questions I'm getting about people are getting assigned. They're doing cash card puts are getting assigned. They're asking me, what do I do? What do they do when you get assigned? Well, really what I'm doing the wheel strategy, but it's might be called a modified version of it because most of my trades are cash secured puts. So I just keep doing cash secured puts over and over and over. And then when I do get a sign, then the will strategy kind of kicks in, and then I do the cover calls, and then it goes back to the cash secured puts, and then I continue on. So I spend 80-90% of my time living right in here, and then maybe 10% of my time is right here where I get assigned the shares. Well, when I get assigned the shares, then I sell cover calls over here, and then they get assigned, shares get sold, and then I'm back in cash, and then I just repeat it again. But before we get too far, I want to make sure that you know that this is not financial advice, just me talking. And subscribe if you like this type of thing. So let's get back to the regular scheduled program. So anyhow, this actually is just right out of the ebook that I created. And if I scroll up to the top here, this is free. It's on the web. You can download it. I'll put a link in the description of this video. So it's basically cash card puts and cover calls, the options beginner guide, how to generate income, simple strategies, trading options. And it goes through from the very beginning, like basically like what is a stock, and then very simple beginning things, and then options for beginners. But then down here, chapter 6 or section 6, I started talking about the wheel strategy and explain exactly how it works and what to do. So just basically repeat the cycle, go over and over. So I'm not going to go through all this. But the one thing I talk about in the book is doing the wheel on a good stock or ETF. In my opinion, this is not financial advice, indexes like QQQ and SPY are like the safest you can do. However, not everybody's got 65 or $70,000, whatever it takes to do a cash card put on SPY or QQQ. I actually use TQQQ or UPRO often to do cash card puts on. Now, it's triple leverage and it's more volatile, but being volatile doesn't really mean dangerous. In fact, it generates more income. So when I'm looking at TQQQ, I'm thinking like, okay, well, do I think QQQ, triple Q will drop 3% in the next 3 weeks? And then I'm kind of looking at the overall markets trending up or sideways or whatever. And then whatever my answer is, I might think, like, I don't think so. So then I might go to TQQQ and think, okay, so this is triple leverage. So I need to take that times 3. So I need to look at like a 10% drop instead of maybe a 3% drop. So if I'm looking at TQQQ at 55, I'm thinking I got to sell cash secured puts at around 50, which is about a 10% drop, right? I'm going to sell cash secured puts around 50 if I want that 3% buffer. Usually what I do, I wait for a red day to come along for TQQQ to drop maybe 3 or 4% down to, let's say, 53 or 52, and then I'll sell cash secured puts at 50 or 48, or, these are just kind of some recent numbers. And so it might be like 7 or 8% less from the opening. So 10% from the opening, I might sell for 10% less. And that's actually kind of what I did today. In fact, if we jump over here, got T triple Q. So the market opened today and it actually was up a little bit, and you might not be able to see it very well, but then it has dropped 6.5%. So $3.50 approximately. When the price got down around 53 or so, actually, let's just take a look. So I sold 3 cash card puts today on T triple Q, and I waited for the price to get down to 53.20, and I sold 3 cash card puts for 50 strike price, and it was the 0.30 delta. So I sold those in here somewhere. Well, the prices continue to drop a couple percent, and so my buffer is still down here around 50, which is below the Bollinger Band. Now, will it go down here to 50? Well, it might, but these are for expiration dates that are 3 weeks away, February 20th. That's how I kind of play things out. And so I guess that's why I don't get assigned a whole lot, with my cash secured puts because I kind of like wait for red days. I wait for when things are already down below the moving averages and already kind of down. You can't guess the bottom. You can guess the bottom, but not consistently. And so I guess that my bottom, I guess, was maybe like 50 or so. And that is between now and February 20th. I'm just guessing that it will be above $50 on February 20th or before. And if it goes back up here to like 55 or 56, and if my premium gets to 50% profit, I'll close that trade early, which I do all the time. So that is a trade that I had today. But let's look at some other things here. Let's look at this really red looking thing here. So this is not good. And typically, you don't see much red on my spreadsheet because I don't sell things at a loss very often. I wait till things are like 50 to 80%. And sometimes it's just a feeling I have. And I watch, the charts a little bit. And I trade differently if I'm home than what I do if I'm away. If I'm away, like traveling on a road trip or vacationing, which we do often, I'm starting to pick some March 20th expiration dates. We are kind of planning on going somewhere. But if I'm going to be going for somewhere for a few weeks and I can't watch this closely, I'll go farther out in expiration and lower on the strike price or lower delta. That way, something happens. I have time for the market to go kind of up and down, sideways, and do its thing for several weeks and not have to worry about getting a sign or anything. And then when I get back from vacation, then I can like watch those trades and then decide when to get out if I want to or let it go to expiration. So, like I said, I trade differently when I'm gone for extended periods of time. I can't watch things as closely than what I do when I'm home. So a couple of trades I'm kind of stuck in right now are these Robinhood trades, and the expiration is February 20th, which is still about 3 weeks away. And I'm in for them between 110 and 120. And Robinhood is trading for, let's see what Robinhood's trading for, 85. So it's down like 5% today. I don't think this is going to get up to 110 between now and the 20th. I hope it recovers somewhat and gets up here somewhere. And so my cost base is probably less than 110, probably like 108. So if it gets at 108, I could probably get out of these trades and kind of break even, probably. But we'll wait and see. But the thing is, if I get assigned these shares, hopefully higher than 85, then that's when I jump back over here and then we do the wheel. The problem you have, if the price is way low, you might not be able to sell cover calls and get much for premium. You might be able to get a little bit, but you might not be able to get much. And the thing you want to avoid doing, or the thing I avoid doing, is if I get assigned shares at 110, I don't want to sell cover calls at 105 and have them taken away at 105. That means I'll lose $5 per share or $500 per contract. If Robinhood's trading, let's say at 100, it's tempting to sell some cover calls at 105 and collect that premium. But then if Robinhood would shoot up past 105, then you may get those shares taken away at 105 and then you've lost that $500. That's the danger. So right now I got these Robinhood shares I'm thinking I might get, and then I got SoFi. If I jump down here and look at this one here, I have a Robinhood cover call. I got to sign these at 115, and it was 102 when I got a sign. But I was able to sell a cover call for February 20th. And if I punch 0 in here, I collected $249 in premium. Now this cover call will probably expire worthless, and I'll keep that whole premium. And then at that point, hopefully Robinhood has recovered a little bit and I can sell another cover call at 115. That's my strike price, and maybe collect some more. Now, what I did with this other one up here, where you see the red, I actually rolled that forward, and that's a big loss here. So I basically bought that back and then did another cash secured put with the same strike price of 105. And down here is where it's at. So if I let this go to expiration, which I kicked that way out to April. If I let that go, I'll collect the whole $1,926. So I'm hoping that Robinhood recovers to 105 between now and April. If not, then I have to decide what I want to do with this one again. This one here, I rolled forward, but these other ones up here, let me get rid of that before I forget. But these ones here, I'll probably just take assignment, like I did this one down here, and then write cover calls on them. And then you can see here I got a cover call on SoFi, and there's not much premium there because SoFi has dropped down quite a bit. So if I put a 0 in here, I collected like less than $100 on this covered call, but it is what it is. So let's pretend this goes all the way to 0 on the 13th and runs out, and I collect the 95. That's still a 25% return on that collateral. So that 12,500, that $95 is a 25% return annualized, or 0.75% for the couple of weeks that this trade was going on. So I should be able to do cover calls on SoFi for around 25, and that's what I got assigned at, is like 25. So this my cost. I don't want to do cover calls below 25 because that's what I paid for. So I should be able to do cover calls for that every couple of weeks. And hopefully SoFi will climb back up, and then I will get back to the point where these get taken away, and then I go back to selling cash secured puts. So really the cover calls are the same as the cash secured puts. Really, you're using collateral, except instead of cash, you're using the shares of stock. So what I don't like for cover calls, you're stuck doing a trade with one ticker because you own those shares. You don't have the choices like a cash secured put. The cash secured put, I could be looking at SoFi, or I could be looking at UPRO, I could be looking at Affirm, I could be looking at the Microsoft double leverage, I could be looking at Tesla double leverage, I could be looking at TQQ. So cash secured put, I can like go shopping and decide, oh, I want to do a cash secured put on this one here because it's having a red day and I think it's going to bounce back up. With a cover call, you are stuck. The only choices I have is how far out do I want to go for expiration, and what strike price do I want to have? Do I want to just pick the strike price where I was assigned, or do I go a little bit higher thinking the price will shoot up? So anyhow, question I was getting from people was, what do you do when you get assigned, or do you roll the trade? Do you get assigned and do cover calls or whatever? I think that depends on you, the person. So for me, I'm okay getting assigned, but you could also go in and look to see what type of premium you could get if you get assigned and doing the cover calls. Now, when I did that for this Robinhood one, and then also for the SoFi one, the cover call premium was actually pretty good. So at the time I'm thinking, oh, Robinhood and SoFi both kind of, start trending back up. These shares will get taken away and I'll be collecting this premium on the way back up. However, if it keeps going down, there's not going to be any premium really to be had. And I'll have to like hang on to these shares for however long it takes for the price to come back up. Now, back in April, that happened with me with TQQQ and probably a couple other tickers. I can't remember for sure. So I had to hold on to those for several weeks until the price came back up. And then I started selling cover calls to the point when they got taken away. And then I was back doing cash secured puts, and then just continued on the way we were planning on doing. Like I said, I like cash secured puts better because I can kind of do shopping and pick the ones I like the best. Where with a cover call, you have those shares, and that's the only thing you can do a cover call on is the shares that you own. So I hope that kind of answered some questions and maybe entertain people for a few minutes. And so you can check my weekly update on these trades and see how things are going. If you've been following me for a while, you see the similar thing happen with PayPal back in October, I think it was. PayPal kept going down, had earnings. Earnings were good. I thought, oh, okay, PayPal is finally on its way. Actually, PayPal had earnings again, like just today or yesterday, and then went down because I guess PayPal is a horrible stock, I guess. But I got stuck. I rolled it forward a couple times for some credits, kind of went sideways, went up a little bit. And at one point I decided, okay, I'm just going to go ahead and get out of this trade and take a loss and use that money for other trades that are more profitable. So that could be a thing that I might do with Robinhood since I have so many. And it's okay to take a loss once in a while. If you look at the weekly premium from last week, it was almost $4,000. And I got this $1,000 loss here, or I'm down 1,000. But these earnings will offset that by the end of the week probably. So I'm down $600 this week. It's part of doing business. If you think of it as a business, and that's how I kind of look at this as a business, they're not all going to be winners. You're going to have winners and losers. And one more little side story. So I had rental properties for years and years and years. You have renters that don't pay rent and you lose money on those empty apartments. and then they end up moving out and they get you for a couple $1,000s. So I'm looking at Robinhood here as a bad tenant. They're ripping me off and they might move out and owe me money. So that's how I look at things. And the older you get and the more you've like suffered some ups and downs like this, the easier it kind of gets. Because you know it's part of doing business and long term, you're in this for the long term, that it's going to be good in the long term. So nobody likes this red stuff that's going on here in the market. If I scroll it on here, these are all the tickers I'm watching. And you can see, TQQQ down 6%, SoFi down, 3.5%, Robinhood down 5%. So it all looks pretty dreadful. But hey, this Apple double leverage is up 1%. So it's not all sad, gloom and doom. And the leverage bank stocks, regional bank stocks, they're up. So that's why it's good to diversify too, deal with a lot of different tickers. So if one or two are getting to you, you have others that are profitable. So, all right. So I'll wrap this up. And, remember that, this is not advice. I'm just me talking and how I'm handling this red stuff going on. That's part of the wheel strategy. And unless the prices go down way far where I can't get any premium by doing cover calls, that'll make me sad. But I'll just wait it out and see what happens. So we'll see you in the next video.